And yes, I said it in a bold statement, I am quitting Bursa Malaysia. Hey guys, what is up? I hope you're having a great new year. Well, technically today is the first day, but anyway, I would like to kickstart 2021 with my plan for the year ahead. What are the investing strategies that I'm opting for, and what are my planned contents for my YouTube channel for the year 2021, and all of those good stuffs. Help me smack the like button down below and subscribe if you haven't already, because we are the coolest community around here, and as I always do, I will always read and reply to every single one of your comments. And with all of that said, let's jump right into today's content. Alright, I'll be upfront with you. My first investing plan for the year 2021 is to liquidate all of my dividend stocks. I know, this means nothing to you, but it means everything to me. Let me explain to you why. 2 years ago, back in July 2019, I started investing in Bursa Malaysia, and being the young chap that I am, I started investing without knowing what's good and what's bad for me. Trust me when I say this, I have no idea which brokerage firm to choose, which investing strategy that I should adopt, and all I have is a young, eager spirit to start investing with the money that I have right after watching a few YouTube videos. So, like most of you have probably gone through, or probably are going through it, you must have read that dividend investing is one of the safest way to invest your money. I mean, buy into defensive blue chip companies and investing in the real estate investment trust or REITs and get the 6 to 8% dividend yield per annum. I mean, how wrong can it go, right? And rightfully so, the young and donkey me made the worst investment decision, and I picked dividend stocks based on their asset quality as well as their dividend yield. And by assets quality, I mean assets that have high demand or high consumer demand. I mean, shopping malls and retail REITs, how wrong can it go, right? And as you all know, when the COVID pandemic hit in March 2020, it all didn't matter, and consequently all the retail outlets and REITs suffered, and at one point my entire portfolio had a paper loss of 7,000 ringgit. Yeah, 7,000 ringgit paper loss for a 25-year-old. I mean, I can easily pay a down payment 10% for a Peridot MyV or a Proton X50, right? And if you think that 7,000 ringgit is not a lot, mind you, that was my second year of employment, and that is a lot of my savings money go down the drain. And one thing that I was proud of myself, and I will say this with pride, I held through it.
Hodl, 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 hodl.
I did not sold a single share through the pandemic from March until November. I held on believing that the market will recover, and I collected more down the road when my entire portfolio was down 45% right in the middle of the pandemic. So after averaging down my cost to a lower level, fortunately until now the entire portfolio has almost recovered down to negative 10% return, and I've also managed to sell my Maybank shares at a 5% return, so that's a plus side for me. Anyway, I'm not trying to tell that dividend investing don't work, but it is just not for me. Trust me, safe is not safe in the stock market. If you think that your 8% per annum dividend yield is enough, trust me, it is not. You have inflation taking out 2%, and then you will also have bad news coming out from the companies or the local political scene, and you also have problems with the US-China trade war going around. So when they all add up, dividend investing just doesn't make sense. And if you still think that 8% is good enough for a defensive portfolio, well, I hope my previous example shed some light for you. One thing that I always endorse, and this is not an investment advice, is to invest into growth companies. Growth companies don't pay out dividends, and they reinvest their profits to support and expand their business, and in return, investors like me and you get our capital appreciation for our investments. Don't mistake growth companies and donkey companies. They are actually good blue chip companies and mid or large cap companies that actually don't pay out dividends, and their year-on-year return is absurd, and I'll leave that as homework for you to find out who they are. Anyways, that is just me, and I am able to take on more risk because I am young. So you should understand what is your risk appetite before you make any investing decisions. And my next investment plan for the year 2021 is to quit Bursa Malaysia. And yes, I said it in a bold statement, I am quitting Bursa Malaysia. Before I explain why, let me show you two charts so you can better visualize my message. This is the Kuala Lumpur Composite Index, the index tracking the top 30 companies in Bursa Malaysia. If you have invested 1 year ago, your total return would be positive 4%. Okay, you say it's the pandemic. What if you invested 5 years ago? Your total return would be negative 2.4%. And if you have invested 10 years ago, your total return would be around 9%. And that is in the context of total return, and I have not split them into yearly return. So if you do the maths, the yearly return would sound really miserable. Now, the second chart, this is the S&P 500 index, the index tracking the top 500 companies in the United States. If you have invested 1 year ago, your total return will be 14.8%. If you have invested 5 years ago, your total return would be 45%. And if you have invested 10 years ago, your total return would be 195%. I hope by now you get what I'm trying to tell you. Both indexes that you have just seen represent the average of the country's economy. And in this case, you would have easily tripled your money if you have invested into the S&P 500 10 years ago. Now, I know some of you would have argued that I shouldn't take the KLSE index to represent the Malaysian economy, and rightfully so. There are still great companies in Malaysia, but how many are there? There are only a handful of them that provides you a good net return. And some would also argue that I shouldn't take the Malaysian economy to compare it with the US economy because it is not comparable, not an apple-to-apple comparison. And they would say that I'm comparing a developing country versus an advanced economy. Well then, you have answered yourself. Why should I invest into a developing country when I can invest into advanced economies that provide me a much higher return? I'm here telling you with good intention. Don't waste your time with the local market if you are looking for a higher return. Well, of course, the past performance does not equate to the future performance, but the difference is so huge that I believe you can make your own judgment. If you are good at picking stocks in the local markets, by all means, go ahead. But for most of the people out there, picking good stocks or good funds is not an easy thing for them at all.
2, 1.
Most of the fund managers out there either underperform or barely beat the S&P 500 index. Sure, you may have 1 or 2 good years, but how sustainable is that? Anyways, I hope you see the reason why I'm quitting Bursa Malaysia. Don't get me wrong though, I totally love this country. I love Malaysia and the people in this country. But when it comes to the country's economics and political stability, I'm sorry to say that we are years behind our neighboring countries. And don't worry, although I no longer invest in the local market, I will still be paying close attention to the contents that I can make to help out the locals here. Be it brokerage apps, any robo-advisory apps, and whatnot. Alright, with all of that said, that leads me to my next plan, which is to invest fully in the US market. Yes, you heard me right. I'll be committing my full energy to research into the companies listed on the New York Stock Exchange as well as the NASDAQ stock market. And if that's something that interests you, smack that like button and subscribe if you haven't already. And as you may or may not know, there is a 30% withholding tax imposed onto the dividends paid out by US companies to non-US residents just like me and you. So it makes no sense for me to invest into any dividend paying companies. And on top of the point that I've made earlier in this video, I will be focusing solely onto growth companies. So there are a few sectors that I will be focusing on. First one is the electric vehicle sector, and I currently hold Tesla and XPeng, with both of them making up to 50% of my entire portfolio. The EV industry have been a boom in 2020, and Tesla have grown more than 1000% in the year 2020 alone. And all the other young EV companies that have just recently IPO'd, such as XPeng, NIO, and Li Auto, have also grown more than 300% in just a few months. And rightfully so, the world is moving towards full carbon neutral and reducing fossil fuel dependency. And on top of that, the newly elected US President Joe Biden also plans to rejoin the Paris Climate Accord. And in simple terms, it means that the US companies will also be investing into renewables and aim to be carbon neutral as well. And with all the advanced economies investing into this industry, we can only expect more headroom to grow for the battery electric vehicle as they aim to take over the automotive industry. The next sector that I'm heavily bullish on is technology, and for this sector I currently hold Apple, which is the leader in consumers electronic gadgets. I believe Apple have the potential to be the leader in 5G technology, finance industry in terms of digital bank, automotive industry in the case of their Apple car, and many other more. And if you have no idea what I'm talking about, I've actually just done a full-blown analysis on Apple just last week. So I will put the link for that video up on the top right corner, so feel free to go and check it out. Anyways, for the technology industries, I'm also eyeing some good companies such as Google, AMD, Tencent and Palantir. So let's see how they fare in 2021. And the next sector that I would like to add more is the e-commerce sector. And for this sector, I actually own a little bit of Alibaba as well as a few of them under the ARK ETFs. So currently they only make a very small portion of my entire portfolio. Now, before COVID-19 struck us, the e-commerce industry has always been the emerging industry that is set to disrupt the brick and mortar retail outlets. And with the ever increasing spending power of millennials who are generally more tech savvy, the COVID-19 has only expedited the shift towards the e-commerce industry. So for this, I aim to add more into the e-commerce industry for companies such as Alibaba, Amazon and Sea Limited, who is the owner of Shopee if you don't know already. And the next sector that I'm also focusing on is the digital finance industry. Companies like Square, PayPal, WeBank and Ant Financials have always been at the forefront of digitizing the banking industry. Imagine having an app in your phone where you can apply for your car loan, your mortgage loan, invest into stocks, ETFs or cryptocurrencies, get paid from your job, roll out saving plans, as well as tracking your budget and expenses. That will make our life so much easier to have everything in our palm. And by now you should realize that I am pretty bullish onto the technology industry, which is theoretically a high risk and high reward industry. But I am pretty confident with the companies from the Silicon Valley, and one will be foolish enough to bet against the US and Chinese tech companies. Now, with all of that said, those are the outlines that I will be following for my portfolio for year 2021. And as it stands right now, my portfolio has a total return of just a little bit over 26%, for which I have gained throughout the past 5 months investing into the US stock market. Now, I'm showing you on Yahoo Finance because my stocks are scattered around Maybank as well as Interactive Brokers. If you are interested to invest in the US stock market, I will put the link down below in the description box where I show you how to choose your international broker as well as how to fund it up until you get your hands onto your first US stocks. Moving on is my YouTube channel plan for the year 2021. You guys have been phenomenal. You guys have been supporting me for the past 6 months ever since I created my YouTube channel back in June 2020. And let me know in the comment section down below which video that made you started following me. When I created this channel, my goal is to help more Malaysians to get started with investing and avoid the common pitfalls, as well as raising awareness so that more Malaysians can do more themselves rather than relying on one single source of income. Today I have diversified my income stream to include investments, affiliates and referrals commissions, some other commission side hustles, and maybe, just maybe, YouTube AdSense revenue maybe this year in June. And until now, I have not received any revenue from YouTube because I have not hit the monetization mark to be able to monetize my videos, because the requirement is to have 1,000 subscribers and 4,000 public watch hours, to which I have hit the former target, but I still have a long way to go to hit the second condition. Anyways, back to my plan. 2021 will be the year where I focus on these few things. I will focus on the core contents that you guys seem to love, such as apps or platform review, be it investing apps, brokerage apps, or any robo-advisory apps like Stashaway. I will also try to include US stocks analysis, forecast outlooks and whatnot, as well as any interesting US market movements that is worth talking about. Then I'll be more active in seeking for collaborations with other content creators as well. I have not been approaching many content creators before this because I would like to focus on my own channel first and build up a sizable following before I even approach anyone. And in a way, I'm respecting other content creators' time as well, because that is more appropriate, right? The next thing that I would also consider is launching live stream sessions, and it could be a weekly stock review or just a general interaction with you guys, because I see that you guys generally love interacting in live stream sessions. Now, with all of that said, I will be setting a big bold target for the year 2021, and I will revisit this video by the end of year 2021. For my YouTube channel, I'm targeting 10,000 subscribers by the end of this year. And I know it's a little bit bold, but I thought it would be better to set a higher target to motivate me to work even harder. 2021 is going to be a very interesting year, and we are already at the beginning of the end for the coronavirus. And hopefully it's also going to be the beginning of a decade-long bull run, so that everyone will be able to profit from it. And if you are still watching up until this point, let me share with you a few nuggets of wisdoms, because you guys deserve the best, and I saved the best for the last. And you guys totally deserve it. If there are a few advice that I would totally tell myself before I even started investing, that is 1. Don't waste your time investing in Bursa Malaysia. Just don't. Your money is better spent diversifying into Singapore, China, or the US market. Just not Malaysia. The market is too small and it is being controlled by the large institutions, and in a way it is a market that is manipulated by the big players. Second, don't waste your time with mutual funds, unit trusts, insurance, investing plans, or PRS. If you are doing for the purpose of tax relief, then fine, go ahead. But if you are looking for a higher return, then please invest into a more advanced economy such as the US and China, because you'll be getting more return as opposed to investing in the local economy. Number 3, don't waste your time with EPF, E-Invest, looking for other mutual funds or whatever funds, because they all charge a very high management fee. Just let your money sit inside EPF and contribute as much as you like, and let it sit for the 5 to 6% dividend that EPF pays out every year. So just let it be. Don't interrupt the compounding interest, and try not to withdraw unless you really need it. And number 4, safe is not safe. If you are still young, i.e. below 40 with not much commitments, then try not to invest in dividend stocks. Your money is better compounded with growth stocks, not dividend stocks. Imagine a company that knows how to manage its cash flow and grows its business year after year. That will be better than you taking out the money and reinvesting into places that you do not know what's the return is gonna be. Sure, dividend stocks sound safe on paper, but it can be easily disrupted by many factors, as evident in this pandemic. So think twice before you invest in the stock market, because safe is not safe. Anything guaranteed is a trap in the stock market. Alright, with all of that said, I hope you find this video interesting and hopefully it opened your eyes in a good way. Feel free to DM me on Instagram or leave a comments down below. You guys know I read and reply to every single one of your comments. Thank you very much for watching. Cheers to the new year. Stay safe, stay invested, and as usual, I will see you in the next one.
Hola,